Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here. As always, sponsored by hardmoneymastermind.com. Go check it out anytime and create a free account. Join the conversation. Okay, so today's topic is creative deal structures. I'll tell you a quick story about why this came up. When we had our last Inner Circle meeting, it was here in Maryland in November. The next one is in May. There is a situation that came up with one of the Inner Circle members, a lender named Logan Ricchetti. And he brought up the scenario as a loan scenario that he was trying to figure out how to structure to the group when we were all in the same room working together. And the way that Jason suggested structuring it is pretty common to us. It's pretty, we do this all the time. It's second nature, right? To a lot of other lenders in the room, even experienced ones, it was new stuff and creative. And that's why we wanted to put out a few examples of what we're talking about, because frankly, we are very used to these structures and we can make these kinds of deals work. And it doesn't even seem like anything that much left field to us, but to other people it might. So hopefully these few examples will help give you some ideas on how you can make deals work as well.
Yeah, we came up with a few samples, two recently closed loans and one that we're structuring today. And again, there's multiple different ways to structure things between cross-collateral, who's going to sign, is it an entity that's purchasing the property? Is it an individual that's purchasing the property? Is it an entity that's owned by multiple other entities? Are you lending money to an organization? Are you actually lending money to a self-directed IRA and there can't be a guarantee involved? So, it's something that you kind of have to think through. And I know a lot of lenders, they just kind of reach out to their attorneys and they say, hey, attorney, this is the loan I want to do for this guy, structure it how you see fit. But I think it's important as a lender and an operator of a hard money or a private lending company that you understand how to do it and get creative, because most of your competition won't know how to structure these things. Some of the easy ones maybe, but they typically won't. And it really gives you the edge. And, some of them are easy. Some of them you have to think outside the box. And I'm going to save the one from today to last today, because that was the most creative and it overlapped into multiple counties with different guarantors and entities and things like that. And, part of it was, hey, I want to structure this deal so he doesn't get hit with recordation tax, which is something popular in our state. Not all states have that. And I want to structure it that way so he's not paying unnecessary money to the government if he doesn't need to. So, okay. So first recent deal was an $800,000 purchase in Virginia. Borrower came to us for the purchase was $800,000. He was buying it in a business entity, and he asked, for how much leverage we could do. And, originally when we were on the phone, before I knew much about it, I was like, well, typically we'll do 80% of the purchase, 100% of the construction. And, I didn't really know much. So he's like, well, I got the construction handled. I can handle that myself. I was like, all right, well, why don't you send the deal over and we'll see. And he was like, well, I don't really want to bring all that money to the table, because that's best case scenario was 20% down plus closing costs. So he's like, I have another property that I just purchased in cash that he paid $800,000 for in cash right down the road. And he's like, can we, is there a way to collateralize that? And I was like, absolutely. So we ended up doing 100% financing for the guy. Why not? He didn't need a dollar out of pocket. Why would he? We had, in essence, $1.6 million in as-is real estate on an $800,000 loan amount, rolled in closing costs, rolled in some monthly payments, grossed the loan up a little bit. So, when someone asks hey, do you do 100% financing? Well, not typically on a single asset, but when there's cross-collateral involved, you can get creative to do so, right? There's pretty much nobody else besides maybe another private lender who knows how to be creative that's going to do something like that. It ended up being the LLC, his LLC for this property was the borrower. And then the other property that we cross-collateralized was that LLC was actually the guarantor as well. So it was, and that's where it gets a little bit tricky. So let's just call it ABC LLC was the borrower. The guarantors were CB, whatever, BCD LLC, and his personal name were the guarantors. And because it's in the same county and in the same state, we did one mortgage, or one deed of trust, collateralizing both properties, right? So it's one deed of trust and it was one title insurance policy, and the deed of trust just has to get recorded once because it was in one county. If it was in multiple counties, you'd have to record it multiple times. You needed a separate deed of trust per recordation office. But since it was one county, we structured it like that. And in essence, if you look at it, it displays both names, both property addresses, and the legal description was displayed. So, again, something that's pretty standard for us, but I can understand why it could be complicated for other private lenders.
Yeah, an easy takeaway from that one before we go into some other examples is always ask. This guy happened to volunteer that he had other properties that could be used as collateral, but typically they don't. So the takeaway that you can implement today is always ask borrowers if they have other collateral when you're having that how much can you lend conversation. And the other takeaway from the beginning, I think, is that yes, your attorney can tell you who can sign legally as borrowers and guarantors, but they're not considering underwriting. They're not considering risk management. It's not what they do. And so part of the reason why it's important to know the deal structure is because underwriting is just as important in that thought as the legal aspect, right? Yeah. So just saying like, oh, I don't know, I'll call my attorney and see who should sign what is kind of not really doing the full job.
I mean, we instruct our attorneys of how to dock these things, and they legally dock it the way that sees fit. But like, we're making the business decisions on them. And again, if you're just starting out, you can certainly run them by the attorney and ask their opinion on things. But okay, so next one was a deal that we recently did in Baltimore. Okay, 3 properties. All 3 of them were in the state of Maryland. The main one was in Baltimore County or Baltimore City. No, that's not true. The main was in Prince George's County. The secondary one was in Baltimore City. The third one was in, I don't know, a county in like southern
County,
Dorchester County in like eastern or southern Maryland. And that one didn't have a ton of value to it. And there was reasonings why, besides just having good collateral and having 3 good assets or 3, all the assets combined, there was rationale behind them. So like the one in Prince George's County, we wanted that one because that had the majority of the collateral and that was a rental property. The Baltimore City one we wanted because that was the exit strategy.
Meaning the property that they would sell to pay us off.
Exactly. We wanted that tied in. And then the Eastern Shore property had cash flow, which could cover some of, additional cash flow to help cover some of the payments. So, and we did a loan of $165 on, call it $500,000, and the guy's credit wasn't all that good. So, it was a lower LTV deal, and we, obviously, we don't necessarily need to over collateralize deals that we do. If we can get away with it, that's fine. But typically, sophisticated real estate investors aren't going to allow you to over collateralize stuff. But in this particular case, he didn't have great credit, and there's a lot of moving pieces. He had income coming from one, he had a lot of value in the other one, he was exiting the other one with a sale. So there was strong reasons to do so. And this is where it gets tricky and in essence, it's expensive. And again, not all states are alike, but in the state of Maryland, every county has its own recordation tax, and you have to record we use a deed of trust. A lot of states are mortgages, but we have to record the deed of trust in every county that we did it in, right? So we had to do, in essence, 3 deeds of trust for $165,000. We still did 1 title insurance policy, but we did 3 deeds of trust. All of them were $165,000. That doesn't mean we have $365,000 loans. That just means that we have a $165,000 lien against all of the properties. So we could collect up to $165,000 no matter what happens on any of them. If one of them sells, we're not dividing it into like, 50,000, 50,000, 65,000. All of them are getting put on record at 165. Now, because of that, he has to pay $165,000 in recordation tax on each one of them. And the way it was set up is his main business entity for the main subject property was our borrower. And then his other business entity and his personal names were the guarantors. And that's how we set it up in this particular way. And, anybody can guarantee. Anyone, can be a business entity. It could be a personal name. We've done loans where we've had like one subject property and 3 cross collateral properties, and all the cross collateral properties were owned by separate people. And they all came in as guarantors of the loan, posting the house as collateral. So there's a lot of different ways to kind of get creative, and I don't want to go too far down and confuse the heck out of everybody on these, but like there's ways to structure some of these things, but at the same time, you want to structure it in the best way on behalf of your, obviously, on your client in order to do so. Anything else to add to that one?
No, I think that's about it for that one. And you had a third one too, one that you're working on currently?
So one that, and I can look at my notes here from today on the screen, because I was working on it today, and I verbally went over it with the borrower and sent a term sheet out. So in essence, it was 4 pieces of property that he had. He had small mortgages on all of them. 2 of them were in Baltimore City. 2 of them were in Baltimore County. He's due on one of the properties because the lender won't extend the loan. He only owes like $50,000 on like 200 or something. So he wants to get that paid off, and his tenant just moved out, and he's going to put a new tenant back in. So that one itself is probably enough collateral, but we're going to tie up one more because that other piece of collateral is tied to the exit strategy. The other one is on the market for, I think, $195,000 to the tenants that are currently living in there. And this is, I hope I don't lose anybody here because this is going to get a little bit confusing on a few different ways. But the subject property, again, has enough collateral that we're good, right? But we want to tie an exit strategy to every deal, especially on refinances. So we're going to tie up this other property that's a rental property, in essence, to, when that sells, he's selling it to the tenants. It's under contract. It's going to sell pretty soon. As soon as the tenants buy that, then we have our exit strategy, right? As soon as that, sale occurs, we'll be able to get paid off. And this is where it gets 2 things that gets tricky. That current property he bought 20 years ago, and he had a home mortgage on that property, right? Now, technically, if you do a loan against the property and the borrower takes cash out for consumer purposes, even if it's an investment property transaction, that still can be looked at as a consumer transaction, right? Because they're using the cash proceeds for consumer purposes. Now, in this particular case, he's not taking any cash out. But if we did a first mortgage on that cross collateral, we'd be paying off what was a consumer mortgage, right? There's an argument that, it was a consumer mortgage and it turned into a rental property. So, technically it got assigned to a commercial purpose loan, which I don't know, whatever. So since we don't really need that collateral besides being tied to as an exit strategy, we're not going to mess with the first mortgage, and we're going to do a second mortgage instead, right? Because he only owes like 40 or 45 and it's on the market and the tenant's buying it for 200. So it's still enough to pay us off to begin with. So we're going to do it that way. And here's the other thing. We could, and they're both in the same county. They're both in Baltimore City, which is the county. So he also has another property in Baltimore County that we could potentially tie up. And I was going to do that instead because it's another property that he's in the process of selling. The problem is, since it's in a different county, we'd have to do the recording. In Baltimore City is very expensive to do of recordation tax. We'd have to record 2 deeds of trust and not 1 deed of trust. And in essence, by doing so, it would cost him a few extra $1,000. So, and he doesn't know that we're structuring it this way. The reason why we structured it this way, but in essence, we're helping him by saving a few $1,000s, so he doesn't have to do that. Now, to make things even more complicated, there's something called an indemnity deed of trust, an IDOT in the state of Maryland. So technically, we can get exempt and get around that a little bit, but most states don't have that, so we don't have to go in that direction.
Is an IDOT exclusive to certain states?
I think it's just
an indemnity deed of trust.
I think it's just a Maryland thing.
Is that right? Interesting. I didn't know that. If you happen to be a deed of trust state, look into that to see if you have an indemnity deed of trust. And really, I know this comes up frequently. Is it a deed of trust or is it a mortgage? It's the same thing. with the exception that a deed of trust needs to list a trustee. In terms of what it actually does, it's the exact same thing. But yeah, that one was pretty creative when you're talking about different borrowers and guarantors in different counties and recordation tax and stuff like that. But I mean, when you think about these things, they're all pretty logical, right? Like there isn't any reason why people who are doing private lending, listen to the podcast right now, can't think through some of these scenarios if you're aware that they're possible. Like what the borrower is, who the guarantor is, where they're located, other collateral. It's all pretty straightforward. Isn't it?
I got to share my screen real quick. So if you're watching this if you're listening to this on iTunes or on a podcast, you're not gonna be able to see this, but I'm going to share my screen just because it's funny real quick. So I Googled indemnity deed of trust. And it says an indemnity deed of trust is a real estate recordable document used in Maryland to avoid payment of recordation and transfer taxes in a real estate transaction. I think it's just a Maryland thing, and you're going to get a kick out of this after I share this screen. And if you're listening to this and you in podcast format and you want to check out our YouTube channel, Hard Money Mastermind, you can see all of this on video. But I went to this website and in essence, like, Hard Money Bankers ads are just popping up everywhere.
Oh, nice. Yeah, bring that up.
Yeah. So.
Oh, damn. Yeah, look at all that remarketing. That is, in case you're not familiar, that is Google display remarketing. So in essence, like anyone within the Google Display Network can show Google ads on their site and earn money for doing so from AdSense. And yeah, Jason just happened to get hit with a bunch of our own ads, which is fantastic.
Yeah. Well. Yeah, hold on. It's. Hey, how's that go? Let me put that back on the screen.
It's an unexpected surprise. I appreciate that.
Yeah, no, it was. Yeah, but I mean, there's 3 of them back to back to back to back to back. So, I like when we get
Don't click any. Don't click any. It'll cost us like $2.
Yeah. Yeah. So, anyways, that's that's that. I mean, the sky's the limit. I've had a lot of questions inside the mastermind group relating to, hey, what's the best way to structure this? And here's kind of the way to think about it. If there's a lot of collateral in the property, there's a good borrower, they own multiple properties, there's probably a way to creatively structure it, as long as you're not obviously doing anything with consumer uses and things like that. Typically we don't mess with second mortgages at all. The only reason we, typically first mortgages, because, a second mortgage has a lot of risk. Like someone might think like, hey, well, they owe 100 on the first and it's worth 200 and I want to do a second. Like there's not all that much room in there. Let's say you need like $20,000 to extract out of it as a second. Chances are that's okay. But let's say they default on you. They're going to default on everything. And then all of a sudden that $100,000 first might end up being, significantly higher. And then in order for you to protect your interest, you might have to pay off that first. You might have to have the liquidity to pay off that first to do so. I would recommend if you're ever going to do a second mortgage, you have to get the promissory note and all the documents from their original loan. If you're behind a bank, there's only so much trouble they can get into. Don't be behind another hard money lender, especially a hard money lender that has like a 24% default rate, because a $100,000 loan in default, turns to like 140 within a year, with legal fees and things like that. So
sure.
The only reason we're doing a second in this particular case is because we have enough collateral from the first, and we want to just have a recordable lien against the other property because he's selling it, and that'll dictate the exit strategy. If not, we won't have any other, organized way for him to pay us off, unless he just pays us off in cash, which he probably will because he's a responsible guy. But it ties us to the deal, ties us to the exit strategy.
Yep. Hope you guys got some good knowledge from that in terms of creative deal structures that you can implement in your lending business right away. Also, real quick, do we have any spots left for May? Maybe one?
That's a good question because I have to check with Dave. I don't know. I mean, we could talk about it if you had, if you want to get in on May.
Yeah, it doesn't hurt to apply. So we might have one spot left. You can apply anytime at hardmoneymastermindinnercircle.com. Talk to Dave Bauer, a program director. See if we have anything open. And we hope to see you guys right here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.